Well, hi everyone, and welcome to the Buffett and Beyond Stock Analysis video. And this week we are going into cybersecurity, which everybody needs and every company needs, and that's Palo Alto Networks. And folks, cybersecurity is the name of the game for all companies. Gotta have it. And remember, if you want to live on this beach like Jimmy Buffett and watch this sunrise like Jimmy Buffett is doing right now, okay, he's not doing it right now because I'm recording this in the afternoon, but he sits on this beach and watches the sunrise. If you want to do that, you've got to learn how to invest even better than Warren Buffett. And for those of you who want the stocks in our portfolios and you want to see our other portfolios that we talk about and you want to receive the daily letters for a while, sign up for our 2-week subscription. All we do is need your email. Go to buffettandbeyond.com, folks. There you go. You'll sign up for everything. You'll receive something every day and 3 videos on Saturday. And let's go over Palo Alto, and it offers a next generation network security platform, and we all know that allows customers to secure their networks. And that's what we want, folks. We want those companies to be able to secure their networks and their content visibility and control while safely enabling the increasingly complex and rapidly growing number of applications running on their networks, folks. They're coming out every day. Okay, let's look at the numbers, and this is for 2024. And the reason is because Palo Alto wasn't making any money until this year. It was losing money. So we're going into the 2024 projections, and the green line is, or the green lines, the vertical lines are Palo Alto, and the blue lines are the average stock in our database, which contains about 1,800 stocks. So when we look at the clean surplus return on equity, we can see Palo Alto is twice as good or twice as efficient as the average stock out there. And when it comes to net income is way up there relative to the average stock. But we're going to see why we get these numbers in the next few slides. Revenue, it is almost tripling the revenue of the average stock out there, and their 5-year revenue is way above this 19.2%, just to let you know. Now, before we go on, I just want to let you know that this chart that you see in front of you and that I'm going to talk about with you was recorded 6 months ago, last August. And I want to show you what I said back then, and then we're going to bring it up to date, and you're going to be totally amazed at what you are going to see. So let us get into what I said exactly 6 months ago, and then we'll go on from there. So let's see what the numbers look like. And over here, the net income, that's the clean surplus earnings. And you can see this company was losing money all the way up until this year. And we may have surprises coming out because their earnings come out next week. So this is just 1 week away, folks. And you can see the clean surplus return on equity was in the negative all these years until just this year, and all of a sudden it shot up, and next year expected to be 27.7%. Retention rate, how much of the money that the company is making, put it back into itself. Everything it makes is going right back into it. The net income growth, and this is that 50% we saw on the last chart, folks, and you have a 2% here, but that's coming off a negative number. So in other words, we're looking at this, so we don't pay attention to this number too much, but look at that 50% growth for next year over this year, which should be a pretty good year. Revenue growth, yeah, we can see this revenue growth has been constantly over the 20% level, and a 5-year average. And by the way, these numbers are expected to go up, and we'll show you that slide in a second when it comes out with earnings next week. But the 5-year average, 27.6%. That's amazing. What we don't care for this company right now is that it has a little bit too much debt. Now, this is Warren Buffett's rule of thumb, is that if a company takes all the money it's making and uses it to pay off debt, how many years will it take to do that? His rule of thumb is 5 years or less. We like to see less than 5 years. We like to see about 3 years. So this worries us a bit. Okay, now here we are. We are comparing the top of this chart in here which is 6 months ago, with today. This is very, very important, and the last thing that I show you on this is going to blow you away, so get ready for this. All right, now we are looking at 2023, 6 months ago, $1.10, and now we are looking at $1.28, and that has been raised. We just don't know what it will be affecting the entire year for another couple of weeks yet. Okay, back 6 months ago, they projected for 2024 $1.65 per share. What are they projecting now? $2.35 a share. So all of a sudden, the clean surplus return on equity has gone from 27.7% for 2024 up to 38.3% for 2024. We move over here. We haven't gotten to the good part yet, folks, so hold on to your hats. Retention rate, 100%. Okay, we know that. Income growth, yeah. Now remember, it went from negative to positive, so that's a big jump in there. We just that's an outlier. But now all of a sudden from 2023 to 2024, we're looking at an 83.6% increase versus just 6 months ago, 50% increase, which is huge anyway. So 83.6 is even huger. Now revenue growth is 16.5%, and it had been projected to be 19.2%. So revenues fell just a little bit, but they're bringing much more to the bottom line. How do we know that? Because the 2024 new numbers, and these are going to be updated in a couple of weeks, $2.35. So we know that even though the revenue has fallen from estimates, they haven't fallen yet, but they're falling from the estimates down to 16.5%. The average is still over 27%, which is what, 4 times the average stock? Yes, it is. Okay, so we know that's okay. We don't have to worry about that. Now, here's the biggie. Back then, we were worried about the years to pay debt. There was a lot of debt there. Now, all of a sudden, years to pay debt is 0. And again, this is Buffett's rule of thumb. He says that if you take all the money that a company is making and use it to pay off its debt, how many years will it take? His rule of thumb is 5 years or less. Our rule of thumb is 3 years or less. But because this company was in cybersecurity and the net income was going up, and this is 6 months ago I'm talking about, we kind of said, okay, but we're going to buy this stock anyway. And this is what we were worried about. Well, folks, not only did their net income go up and their return on equity go up, but they paid down all their debt. There is no debt in this company as we speak. So now we have a whole different company, and boy, are we glad that we put this stock into our portfolio because it is in cybersecurity. And folks, we need cybersecurity. Now let's go and see what 1 year was 6 months ago. So this is projected from 6 months ago, and because there's 2 colored lines in here, again, black line is the S&P 500. We compared it with Fortinet, and we'll do Fortinet at a next time, maybe just next week. But the grayish line is Palo Alto, and with the market at that time up less than 10%, Palo Alto was up about 28%. Now, let's bring it up to date. Now, today, as I'm recording this in February, the market is up to about 20%, and this stock is up to 105%. Let's go back. Okay, the market was at about 8%. Now it's at more than double that. And Palo Alto was at about 28%, and now it's up for the past year 105%. That's a big move. Let's go on. Now, we looked over 5 years. This was 6 months ago. What did we expect out of Palo Alto? It was up about 200% going back 5 years from 6 months ago. And where was the market? Oh, up about 60%. Now, up to today, what is the market up to? About 70%, maybe 80%. This stock is what? Up 400%. Now you can see why our portfolios that contain Palo Alto are doing so well. And this is one of the stocks that are just blowing it away, folks. I mean, okay, is it overvalued? Have no clue, because we don't know where the top is in any stock at any particular time. And so when people say the valuations are high, well, they're always high in a bull market. And guess what? We're in a bull market. We're at new highs, aren't we? Yeah, the other day we had a little drawback, but now all of a sudden we're moving back up to all those new highs again. So 5 years, 400%, folks, this is the kind of stock we want in our portfolio, and we've had it now for a while, and we are just so happy that we did. We're doing really well with it. So, folks, we had a tumultuous week this week. I always wanted to use that word, but we had a tough week where I think it was on Tuesday that we had a big drop in the market when the market realized that the Fed was not going to drop interest rates like tomorrow, that it might be June, it might even be after that. But the thing is, the economy is growing. All the numbers are showing that. So we do have a strong economy, and we still have inflation coming down. It's not coming down as fast as everybody wants it to, but folks, it's still coming down. And the Fed sees that. So sooner or later, we're going to get an interest rate drop. And if we don't, as long as inflation comes down, the economy is doing just fine. The jobs report numbers are coming out better than expected. So, yeah. I mean, it's looking pretty good out there. So things are only going to get better as we go along. So folks, wound up having a pretty good week. So you go out, you go to the beach. And my sister from up north, who lives up in the Hudson River Valley, sent a picture of all the snow they've had. And down here in Florida, we do not have that problem. Anyway, folks, go out, have a good weekend, be with your family, be with your loved ones, take your mind off the market, because we'll be back here with you on Monday.